Thank you very much, James Bullard, President of the Federal Reserve Bank of St. Louis, a veteran of St. Louis to the extent that this is your 30th anniversary year, I believe, since you've been at St. Louis, man and boy. And of course, you took over as the president and a member of the FOMC in April 2008, making you not quite the longest lived, but certainly the second longest lived, second person with the longest tenure on the FOMC. This has clearly borne you in very good stead, Jim. Just on the past, just for a moment before we go to the present and the future, do you think the Fed, based on all the experience that you've had there over the last 12 years, was well prepared for this pandemic? I did read again just now Janet Yellen's speech from October 2017, the Herbert Steen Memorial Lecture, when she very carefully laid out more or less what you've done now. Clearly, you've done it more extravagantly. Were you well prepared?
I do think it prepared us well to have gone through the 2007 to 2009 crisis, which, you know, it took a long time to get the same steps made during that period because it was all brand new. Here, I think there was a lot of agreement that this was a major shock. There's a lot of agreement that you definitely wanted to handle the pandemic, but handle it in a way that did not create a financial crisis. And so the very relatively quick response was to go to the 13.3 type programs and provide liquidity to financial markets. And so far, I think that has worked quite well. There were problems with market functioning in March and maybe into April a little bit, but most of those have corrected. You could argue about it. So I think as far as the initial wave, I think the response has been much faster than it was in the previous crisis, and that has served us very well in terms of market liquidity, preventing this from morphing into a financial crisis, at least so far. And so I think the initial response has been quite good.
We'll come on to the macro questions in a moment, Jim, but if you just look at the way that the different desks were set up in March, you said that you reacted better or more quickly than maybe in 2007 to 2009. Did particularly the New York Fed, did they have all the operational equipment, so to speak, for these extraordinary measures that they've taken in areas like, say, the commercial credit or the commercial paper? Was that laid down in advance, or did they more or less make that up on the night? Clearly, the Treasury function and the mortgage securities and so on, you might have had that already in your playbook. There were some new things. Did this innovative approach just get dreamt up very, very quickly, or was there some sort of a rehearsal sheet for all that?
Well, you know, most of this is about making sure that markets are functioning, making sure you have price discovery, making sure that you have active trading in various markets. And if you don't, we know that the freezing up of markets, the sense that you can't trade an asset at any price under any circumstances, that's what causes a crisis atmosphere and makes people really panic. So to the extent we've been able to be a backstop in a lot of markets, I think that's what has really helped us in the initial phases of this pandemic crisis. And so I think it's so far so good. And some of this, I think, interestingly, from an economics point of view, some of the effects occurred without the program actually being set up. It was the announcement that the program would be set up that calmed markets, and some of those are just coming online today or in the near future here. So, yeah.
The ETF, for example, the Fed didn't have to buy a single security. You just announced that. I think only overnight has it started.
But I think from a market point of view, it showed that the central bank was, concerned about market functioning, concerned about these issues, and wanting to make sure that we had price discovery and active trading in markets that might otherwise be threatened.
then we've seen a lot of international coordination as well from the central bank. There's been less so regarding politics in general, but the central banking cooperation seems to be functioning pretty well internationally. The extension of the swap lines, for example, happened relatively quickly. The United States, we all know the Fed is the central bank for the United States, not for the world, but in some ways, you've been very quick to capitalize on and live up to the international expectations that the different parts of the world do place in you. Was that also all predetermined, would you say, or was that a sudden burst of blood to the head that made the Fed suddenly much more international?
I think that we learned from the 2007 to 2009 that the swap lines are quite important. Obviously, it's an international dollar funding issue, but we had standing swap lines with a number of major central banks around the world. I think the question was always, to what extent do you want to extend these swap line arrangements to other central banks? And I think we've come upon a good solution to that. We did extend to other central banks, but then in addition to that, we created a facility where foreign entities can come directly to the New York Fed and swap out their treasury securities for dollars. And this is a way to get dollar funding in other parts of the world where it's needed. So that, I think, calmed markets quite a bit again. But I would emphasize, I don't really think this is not a financial crisis, and it's really not centered on Wall Street or in London or in financial markets around the world. This is definitely a health crisis. It's from an economics perspective, it's an exogenous type of shock, and the goal here is to make this not morph into a financial crisis and make things much worse than they would otherwise be. And so far, I think we're doing that, but it's not really, emanating from financial markets. So it's, in that sense, I think we've got good trading going on. We've got good price discovery going on. I think that part is working very well, at least so far. I would say also, though, we cannot hit the pause button for very long in major economies around the world, and certainly not in the US. I think there's a 90-day limit shelf life on this policy, maybe 120-day shelf life. After that, you have to, you can't continue the shutdown policy because too many other things will start to happen. You'll get business failures on a grand scale, and you'll be taking risk that you'd go into depression. So I really don't think you can go too long with this policy. I think the shutdown policy, is rational at the beginning, where the pandemic catches everybody by surprise and you really need to get the disease under control. But this is not a risk-based policy. It's a blanket type policy where all economic entities, except those deemed essential, are supposed to cease activity. And the economy can't behave like that. You've got all these businesses and nonprofit entities that have no revenue stream whatsoever. And yeah, they might have some cash on hand. They might have some other ways to survive for a while, but that can't go on indefinitely. You'll get too many business failures and you'll really do lasting damage. So I think we have to get away from the shutdown policy and towards something that is more about risk mitigation. We have lots of mortality risk around the economy, and we have lots of ways of handling that mortality risk. One couple that I'd like to mention are terrorism risk and traffic mortality risk. Both of those cases, can be, very dangerous. That doesn't mean we shut the economy down. We take risk mitigating measures in order to control terrorism risk. We take risk mitigation measures to have traffic safety and to try to prevent fatalities there. And I think the same thing has to be true for this disease or any other disease. You have to get, You have to get more granular about exactly how you want to handle the mortality risk, and work toward that type of policy. The shutdown policy is way too much of a blanket policy where we're just going to shut everything down. That isn't working from an economic point of view, and can only be done in the earliest phases of the pandemic. But longer term, we're going to have to get a lot better at this.
Well, that's right. And of course, it's also extraordinarily expensive, isn't it? If you just shift now to where we are now, the deficit will clearly rise to what, 10, 11% of GDP this year. A huge amount of funding will have to be done. This is just while we're in this present phase, which, as you say, cannot last forever. There's clearly a trade-off, isn't there, between knocking everything on the head in this very blanket way, as you say, and the costs. And even the world's reserve currency cannot go on forever like this. You say it's a 90-day issue. Are you reasonably confident that this emergence from lockdown, which we're seeing in very different pace in different parts of the United States of America, that we will, in say another 90 days, be in a better place, and we'll see some sort of gradual recovery starting to take shape in the third quarter?
I do think that most of the damage will be right here in the second quarter. I think the forecasts are for GDP growth at an annual rate to be the most negative of all time. But I think the third quarter will come behind that with probably the highest GDP growth rate at an annual rate of all time as well. So in some sense, you'll have a very negative quarter followed by a very positive quarter off of a low base.
Jim, sorry to interrupt. We're talking about double figures in both cases. Do you think?
Wall Street has the second quarter in the U.S. being, on the order of a minus 40% at an annual rate, a staggering figure and way beyond anything that was experienced in the post-war era in the U.S. And then the third quarter will probably be just the opposite, some big plus number. But, and we do have an example of a country that had exactly this happen, which is China. It makes perfect sense. You're asking these businesses to shut down. You're asking people to stay at home. Of course, you don't get very much output during that period. And then you tell people that they can come back to work under certain safety restrictions. You're going to get more output, and it's going to look like a high growth rate. So I think macroeconomists have had a hard time getting their head around this shock and how different it is from all these past shocks that we've experienced. This is not the same thing. And the numbers are way off the scale. So I think, we have to think about it a little bit differently than we have for other types of shocks.
I think you've been helpful in some recent interviews by putting this into context of other pandemics like in 1957 or 1968, but just staying for a while on this idea that it may not work, the 90-day limit may be breached, and we may be back into another scenario, say a second wave or even a third wave. What other tools does the Fed have? Are you just going to continue to use your unconventional tools? You're up to a balance sheet of about $6 trillion now, I think. Could that go still higher? Could you go into negative rates? I know this is an often posed question to you, Jim. What other tools do you have in the box in case things do take a turn for the worse?
Yeah, we've talked about negative rates on and off over the years. It's not a good solution in the US. We have different short-term funding markets than either Europe or Japan. And I don't think it's a very good option for the US. And I also think that the track record is mixed, both in Japan and in Europe, as far as the success of negative rates. You'll get an argument on that, but it doesn't look like a panacea, that's for sure. So I think that the probably more likely is a quantitative easing program, more explicit than what we have today, and an attempt to keep rates low for a while. I don't think that this is really an interest rate story right now. Markets are not really hanging on, questions about whether where rates are going to go. Everyone understands rates are going to stay where they are for quite a while here. maybe when we get into the second half of the year, we'll get more sensitivity to rate policy. But right now, I think everyone just understands, well, we've moved the policy rate to 0 and it's going to stay there. And that's that, at least for the foreseeable
on that
future.
question, again, a very common question that you've always been asked. Last time, between 2008 and 2015, it took about 6 years for policy to start to be normalized. Throwing on your crystal ball, looking to the future, normalization, is it just a ridiculous thing even to think about at the moment?
Yeah, I mean, I certainly wouldn't worry about it at the moment. I don't think our normalization, worked all that well. And when we were first talking about normalization, I was an advocate, but as it went on, I started to wonder, what were we trying to do with the normalization policy? Because the entire time, inflation was actually running below target. So we were raising rates with inflation below target, and we were having a hard time getting it toward target. And it just became less and less clear what we were trying to accomplish. And that made me think that it wasn't that good of a policy. And I switched and started to argue against it. But
well, that was your switch in 2016.
This time around,
that was 2016, wasn't it?
Japan and Europe staying at low rates for the foreseeable future, and I think the U.S. will be right alongside them in this circumstance.
Do you think that the unemployment numbers are going to get to a size where this is going to really cause social unrest? Because again, we're off the scale, aren't we, in terms of the unemployment rate? I think even in the Great Depression, we had 25% unemployment. Now, on some levels, it's going to be 30%. If that is remaining just temporary, okay, fine. But is there going to be social unrest in the United States if unemployment, for some reason, were to stay at these extremely elevated levels, despite all the money the federal government and state governments are throwing at it, and despite all what you're doing in the Fed? Are we going to see social unrest?
Yeah, there's no question. You're taking depression risk here in an experiment that is scaled at depression levels, and I hope we can execute it properly. And I do think it makes sense. I think we can. My base case is that we can execute it properly, but what we're doing is asking people to stay home to get the disease under control, and we're using the unemployment insurance program in order to compensate people who've been disrupted by this health policy. We think our blog on this suggests that there are 47 million workers at risk of losing their jobs over this. And we want to get them and keep them whole during this period, and hopefully keep them in contact with their employers so that as we reopen, they can go back to work, and we get a sharp fall in the unemployment rate in the second half of the year. And I do think we can execute that. I do think that could happen, and that is my base case. But it could go badly awry. You're always taking risk when you're doing a one-time policy like this. And that's why I want to come back to the health policy. You can only play this card once, that you're going to shut down the economy. You can only do that when you're totally surprised by some disease that comes along. After that, you have to take a more careful approach, a more granular approach, a more risk-based approach. Show me exactly where the virus is, show me how the virus is being transmitted, mitigate those exact areas so that you limit the spread of the disease. It's not feasible to just say every single person around the world just has to go home and the world is going to plunge into deep depression. We take mortality risk every day. We can manage this better, and we will have to manage it better going forward. Also, we're spending too much time thinking about vaccine coming to the rescue. There's never been a vaccine for a virus of this type that I'm aware of. And I do not think we can just stay shut down until the vaccine comes along. That might never happen. Even if it does, the vaccine might not be all that effective, and the virus can mutate anyway. So I think you
Well,
want to think in
might be
terms
the
of
wrong
risk
kind of,
management.
it might be the
It's
wrong kind of
about risk
vaccine or the
management.
wrong kind of virus. I mean, I've got several questions coming in, particularly on the medical side. Just I mentioned earlier, though, on the 1957-1968 pandemics, you took the slightly rosy view that although those were worse in some ways in terms of fatalities in the United States, but each time the United States economy bounced back. One of the listeners, he says he or she misses a sense of urgency because the banks are going to be in a very poor state afterwards. There's going to be non-performing loans. There'll be financial stability problems, plus the lack of a social security network. The listener says, are you not missing here a sense of urgency about how bad it could all get?
Oh, it can get very bad, but that's because of the shutdown policy, not because of the pandemic per se. The pandemic, we've had worse pandemics in 1957, 58 in particular. Let me talk about that one. According to the CDC, that's 116,000 fatalities on a population base of about 175 million. That's a fatality rate of 0.00066. If you do that same calculation for this pandemic based on current projections, you're going to get a lower fatality rate. It's about a 0.0004, I think. And you know, the thing about the 57, 58 pandemic is there was nothing about that said that the U.S. was going to be in a decade of malaise or something like that. The 60s were one of the best decades we ever had. So there isn't anything about the pandemic per se. It's a human tragedy, it's a health tragedy, but it doesn't have to be an economic tragedy. The economic part is coming from the shutdown policy associated with the pandemic, which was not there in 1958, but is there today and is really threatening the US economy and the global economy. That's why we have to get better at this and get more risk-based with our health policy. Otherwise, we're going to risk a depression scenario. Also,
well,
the 1918, I can talk about that too. Yeah.
No, let's just make it the international dimension, because the difference with 1957 or 1968, I guess, must be the fact you've got this synchronized disease striking everywhere, more or less.
No,
at the same time.
those were global. Those were global. 68 came out of Vietnam, soldiers coming back and so on. They're both global.
Well, but the point is there is now a synchronized downturn everywhere, and there were already worries about world trade last year before anybody heard of coronavirus. If you throw together the downturns, the debt levels which we have, which are very high, we all know the countries were not in a good place before this crisis struck, plus the fact that there's been an assault on the global liberal trading order for various reasons, which happened already. You throw all those things together, this could surely be a more potent cocktail than anything we've seen, certainly since the Great Depression.
Yeah, I agree. It's a risky situation, and obviously the second quarter here is going to be, very negative. I think the second half will naturally be a lot more positive, and the question will be how fast can we recover and come back to something more normal. And then we have to face the other problems that we were already talking about, including trade issues. But I think that, one step at a time here. I think we're really at the height of the crisis in terms of labor markets and macroeconomic performance, because you've still got major shutdowns in major economies around the world. But if we get to a more risk-based approach to controlling the disease in the second half of the year, you'll see a lot of opening up. You'll see faster growth rates, and we'll be able to see where we are. On the question of the banks and so on, I think that, so far so good. I actually think they might come out okay through this process, despite some credit risks out there, because they're also doing a lot to help with at least in the US, they're doing a lot to help with the relief packages that have been approved by Congress.
And of course, the banks are in much better shape than they were in, say, 2007, 2008. That is clearly the case. And you're also bringing in some mitigation in terms of forbearance. Some of the things the banks didn't like, you're actually lightening some of those loads. Can I just ask you, given the fact you're still painting a relatively sanguine view about the United States economy, and I think you've got some good reasons for this, is this a type of emergency situation where only the world's reserve currency country can actually take the kind of action that you are taking? You're basically saying forget about the deficit for a few years, perhaps for several years, we can finance this. I'm not going to use the word exorbitant privilege because I know you Americans don't like it, invented in France. But there is something in this, isn't there? You are still the world's sought after currency, so you can get away with this. What about the rest of the world?
Yeah, I think on the question of how to pay for this, we're definitely have the idea that we're going to borrow a lot and provide pandemic relief through that channel. We're going to come out of this with higher levels of debt to GDP than we had before. I've thought of maybe 10% or 15% higher debt to GDP ratio than we had before. We have low interest rates for probably for a long time to come, so that looks like the debt burden won't be as severe because of that. You have other countries, obviously, that don't have, as much room on this kind of dimension. I would say something else, though, that part of the way to pay for this is when production is down, consume less. I mean, that doesn't. It sounds, simple, but your standard of living is lower. You can't consume the same kinds of things that you would have before. You can't go to the soccer match and you can't go to the restaurant, and so you're kind of lying low, not consuming very much. And so in that sense, I think you can pay for things directly right away just by saying, my lifestyle's been cut in half or something, and so therefore I'm just going to have a bad quarter from a standard of living perspective. So there's some of that going on as well. You see that showing up in high savings rates, for instance. People don't have any, they can't go on holiday, they can't do other things. So because of that, they're just not spending the way they used to. That's a little bit of a bullish factor when we come out of this, I think, is that.
Well, I can see that, but again, just hammering away my point, is this really something where the United States is going to actually come out of this quicker and in a more healthy state than everybody else because you've got the dollar behind you? And will this not actually preserve and enshrine the dollar's supreme role in the world economy?
Yeah, well, I've long argued that the dollar as a reserve currency is probably something that's here to stay for quite a while. The major challengers are not in a position to really take the leading role. It may happen, but I think it's still decades away at this point. Anything from cryptocurrency to China, Japan, Europe, they're not in position at this point to challenge the dollar.
I mean, I know you've always said that, and you've been proven right so far. Has the gap between you and the also-rans, has it widened in the last 6 months?
Have they what?
Has the gap between you and the also-rans, the runners-up in this race, the euro, the renminbi, and so on, has the gap between the
I would say yes. I would say the gap has gotten even bigger because this is obviously a crisis for Europe, going back into a deep recession without very much policy space. Japan has been, struggling to handle recessions for several years or quite a while, decades or more. And China now, I think, not going to be as attractive as a place to locate supply chains and so on. So they've also got their own issues. So I would say the gap has gotten bigger.
And the question has come in about what's going to happen in the future in terms of inflation or deflation. Would you say normalization will actually take, say, 6 years to produce just like it did last time? Or could we get a shock? There could be inflation coming out of this crisis, as sometimes has happened in the past. Could you give your view on that, please, Jim?
I'm not seeing inflation risk. I'll certainly be very alert to it. I remain an inflation hawk, but boy, inflation hasn't been a problem in recent years. And if you look at other parts of the world, it just hasn't been a problem. So I think central banks have either by accident or good policy have vanquished the inflation dragon at least for now. And so I'm not really seeing that as a likely concern. Even with the additional debt being taken on here, you never know, and we'll certainly be vigilant about it. And we do intend to hit our 2% inflation targets, but we haven't had any trouble on the high side. It's all been on the low side in recent years.
And another question about the future: where do you think the Federal Reserve balance sheet will actually end up? Some people are talking about it getting into double figures of trillions. What's your view? If you had to put a bet on it, Jim, will we exceed 10 trillion in a couple of years?
That sounds high to me, but I think these programs obviously are increasing the size of the balance sheet, and we're doing a lot right now. We're kind of at the height of the crisis. I think some of this will unwind, as the crisis abates, and the size of the balance sheet will come down. But exactly where we're going to end up here, I wouldn't want to hazard a guess right now, because there's just too much uncertainty, and we're too much in the middle of the crisis at this point.
One of the listeners puts the question, are the financial markets not totally ahead of the real economy? And of course, that plays into what you just said, because the reason why the financial markets are relatively buoyant at the moment in terms of stock markets is because they think that the central banks will come riding in to rescue the ship and will actually do the bit. We're back to the Greenspan put. Is that not dangerous? I hesitate to use the word moral hazard, but does that not come into it, that the financial markets are relatively buoyant because they just expect you're going to be there to bail them out?
That's been a long-standing argument, but I've always felt like stabilization policy was all about exactly that. It was you're trying to get the economy to grow at a smooth rate if you can, and so you're trying to mitigate the downturns and trim off the excesses on the high side, and so that you get a nice smooth growth rate. And that's what stabilization policy is. In markets, that gets interpreted as a put, but to me, that's just ordinary stabilization policy.
Yeah, well, so far so good. There's obviously an issue about the future regarding the relationship between, say, the US Treasury and the Fed. Now, you've got this dual mandate, which has always made you more subject, shall we say, to the wishes of politicians. One would hesitate to use the word total independence for any central bank. But do you think there's just necessarily going to be much more coordination now in the future between the Treasury and the executive in Washington and you on the FOMC, whether you like it or not, the ability to operate in an area which is semi-free of politics? That ability is going to get more and more constrained. Would you support such a view that I'm just putting forward?
I do think that the cooperation has been very good here between the Treasury and the Fed, and I would commend Chair Powell and Treasury Secretary Mnuchin. They've been excellent on this. But the reason for that is because the pandemic swept into town, and it became really apparent that we had to really move quickly. And you had great action, I thought, taken by the Congress on very short timescales. And you had widespread agreement that it was the right time to bring out the 13.3 programs, which require, under Dodd-Frank, now require the Treasury Secretary's approval. And because of the nature of this shock, it was everyone saw there was a huge problem. Everyone saw that we had to take action very quickly, and boom, all happened. So I think the U.S. politics and other countries' politics often gets derided for being dysfunctional, and U.S. politics especially. But here was a case where you had the Senate voting unanimously on the $2.3 trillion package. I mean, you can't get the senators to agree on a resolution that says the sky is blue. You're going to get 20 no votes on that. So I think, to have everybody on the same page and willing to go ahead and recognizing the nature of the crisis, I thought that was excellent. And that really bodes well. That really bodes well for our ability to get through this crisis.
I mean, you're right. I mean, almost too good to be true. And the fact that the president has stopped criticizing the Federal Reserve, I mean, is that a good or a bad thing? Because surely you have to have a bit of invective coming at you from Washington. Otherwise, you feel the world is no longer normal. But seriously, was there a lot of behind the scenes lobbying by people like Janet Yellen to actually help get the congressmen on side, congressmen and congresswomen? Because there must have been some sort of attempt to make the House of Representatives and the Senate see a certain amount of sense. Otherwise, why would this outbreak of common sense have come all of a sudden in March? It does seem rather strange and almost, as I say, almost too good to be true.
Well, I think what will happen is, as you go forward here, that it won't be so obvious as that you're facing some big shock or some big crisis or something, and you'll devolve into the normal sort of political competition that occurs, and maybe that's already happening over the continuing discussions about additional actions in Congress, which seem to be deadlocked right now. So. But I'm impressed with the ability of our political system to respond to a true crisis that was widely recognized across the political spectrum. I do think that the amounts of support that were talked about and that have been implemented are approximately on the right scale for this kind of crisis, and we're trying to provide pandemic relief to disrupted workers and disrupted businesses, keep them whole, and hopefully get to late summer sometime and things are closer to normal. They won't be perfectly normal, but closer to normal. They'll be able to resume production. We'll have faster growth, and hopefully we'll be able to put this crisis behind us.
And specifically to that, a question has just said, a very specific part of what you've just been talking about, what does the Fed make of the Paycheck Protection Program? Reported numbers are huge, but you wouldn't know that by looking at the unemployment statistics. I mean, that's very much part of the solution, isn't it? But do you have a specific point about that program? When it was being set up, it was set up very, very rapidly, and it was designed to, those are loans, but they're forgivable under certain circumstances, including keeping a certain percentage of your workers on the payroll. So in a way, it's providing pandemic relief through another channel. Instead of sending your workers over to the unemployment insurance line, you keep them on the payroll. They're really not doing very much because your business has been shut down by the health authorities. So you're really providing the same kind of relief through a different channel. And for some businesses, that might be a better way to go because you keep your team intact and you're ready to go when the pandemic has weakened in the future. So I think it's been successful. It's been done so quickly that you would expect all kinds of chaos around it, which has been the case. It's going to be unevenly distributed across the businesses in the country. You're going to hear all kinds of stories about this business or that business, a business that was helped tremendously and another business that maybe wasn't so deserving or something. And we're seeing lots of stories about that. But I think the spirit of this has been get the pandemic relief out there right now, right when it's needed. And this was a fast way to do that. And I have to commend the Small Business Administration for handling this program. This is way beyond what they would normally be doing. But they were up to the challenge and have been able to get these checks out to businesses relatively rapidly. We're getting towards the end of the talk. Maybe we'll overrun by just 1 or 2 minutes because there's quite a few questions still coming in. I want to ask you a question right at the very end, Jim, about US politics as well, if I may. But he's got a very policy-orientated audience here, rather geekish, I would say. So one person, very much a man or a woman after your own heart, says, what about the strategy review? You seem to have shelved that for the time being. This person wants to know when the strategy review will see the light of day.
Yeah, I mean, obviously the pandemic put a monkey wrench in that timeline, but I do think we'll come back to this. I'll leave it up to the chair as to how he wants to do the timing on this. We did do a lot of work on this in 2019. We had a lot of outreach in various ways. We got academic input and sort of input from non-policymaker type feedback, and so I think it was a good process. And I think there are some good ideas in there, so I think we can go ahead and try to implement those, but exactly how that's going to be done, I'm going to leave that up to the chair.
And that will be what, mid 2021 at the earliest, I would have thought.
Yeah, I don't know what the timeline could be on that. We'll see what Jay wants to do.
All right, I'm sure they won't be able to do it without you there, Jim. Another issue that's come up about the future, you said that it's going to be very helpful to have low interest rates because of this extra debt that the United States is going to take on. The listener wants to know whether we could have yield curve control. Could take us back to the wartime years, of course, if there was a legislative pressure for the Fed never to raise interest rates above a certain level. As part of the Fed and the Treasury all doing their bit together, do you think that's a possibility for the next year or so, that there could be almost legislative but certain very strong pressure for you to introduce yield curve control?
Yeah, we could certainly look at it. My sense, though, I want to convey this, that I just don't think this is really a situation where there's a lot of interest rate sensitivity in markets, because rates are low and rates are expected to stay low all the way out the yield curve. So whether we have yield curve control or not, it's certainly, it's basically the same thing right now. So we'll see how we want to play this forward guidance over the summer and into the fall. But I don't really expect to get back to a situation where markets are really interest rate sensitive very soon. I think everyone's expecting rates to stay low. I think that's the right expectation right now. And everything that's driving markets is virus news. Much like wartime, in wartime, what drives the market is news from the front. And here you're kind of at war with this virus, and it's news from the front that's driving everything. And that's kind of how you'd expect things to behave during this period. And then we'll get back at some point, the virus will fade a little bit, and we'll get back more toward interest rate policy. And at that point, it will be more important for the Fed to lay out future plans.
A question about gold. There's always one on every one of these virtual meetings. I don't know whether the listener is from Texas. But what will be the role of gold in the future as a result of this crisis and this dislocation that we've had?
I'm not seeing a big change due to the crisis. I think gold would be a play against inflation risk. And inflation really hasn't materialized out of the 2007 to 2009 period. The big central bank balance sheets have proven not to be very inflationary, at least for now, certainly over the last decade. I just don't see a lot of inflation pressure, so I think gold is going to continue to play the same role that it has as an inflation hedge, but frankly, there hasn't been much inflation.
Just guiding us towards the future, societal change. One listener wants to know, will there be pressure for change in the social security system to have a greater degree of safety net? And also, will the lack of a social security system, or properly functioning social security system in the United States, automatically put pressure on the banks? Because there's going to be foreclosures, there's going to be all kinds of distress amongst households and amongst businesses, which will inevitably put pressure on the bank. So could you lump those two questions together, please?
Yeah, I mean, I'm not sure I want to describe the Social Security / Medicare program as quite as dysfunctional as it seems to be described in that question. It's a big program, and jointly that takes up a lot of tax dollars. And the concern has been that that's growing over, that transfer program is growing over time in a way that might spin out of control. That is still with us as an issue as the population continues to age. Not much has been done about it. So in that sense, I think it's a potential crisis that's still sitting out there in the future. I'm not seeing the pandemic per se as driving that more acutely, but I could be convinced otherwise.
And just two more questions, Jim, before we will close. You're talking about the economy potentially being onto a winning streak in the second half, if everything goes well. You and your colleagues on the FMC have said that. How is that going to play out in the election? Will that come just in time to help the incumbent?
Yeah, I mean, I have no idea. I would just say one thing about this is that you know, the pandemic coming and going and all kinds of arguments about it and unprecedented economic numbers. If you look at the polling data, it barely budges. So I think people, for whatever reasons, they've got their minds made up one way or the other, and this doesn't seem to make big swings in the political world as far as I can tell.
And the final question is really the future shape of central banking. You've seen a lot since you became the president in 2008. You've seen a lot of upheaval. This is a greater upheaval than we've had any time in peacetime, certainly in the last century and a half. What have you learned from this? Also, you spoke earlier about the coordination function between the United States Treasury and the Federal Reserve. Are we going to see a completely new rule book, so to speak, for the way that the central banks and the governments act and work together? You know, one the heart, the other the lungs of individual countries' economies. Are we going to be going into a new chapter, if you like, of central banking as a result of what we've learned and still will learn from this crisis?
I do think that the future of central banking is in flux because a lot of theories did not really pan out post great financial crisis, and that led to a lot of soul searching. Now you're going to have even more of you know, sort of theories not working correctly or not working according to the way they worked in the lab. And this is going to make people sort of re-examine what are we trying to do in central banking, and what is the nexus between monetary and fiscal policy, which is a classic question, but I think it's really you know, more soul searching ahead, I guess, is what I would say for central bankers.
Well, lots to get your teeth into. I never quite managed to find out how the job function happens in St. Louis. But you look as though you're there for a few more years to go. You're still only a young man, Jim. You put forward this idea 3 years ago that there needed to be a regime change for you to change your views on monetary policy. Well, we certainly have seen some kind of a change. There's going to be a huge amount to discuss in coming years, not just in the United States, but also in the rest of the world economy. I do hope that you're right, and we can see this gradual upturn taking shape in the next few weeks and months, and hopefully we'll be on a better track by the end of the year. So I'd like to thank you very much indeed, Jim, for giving us the time. You've dispensed very well with all the questions that were thrown at you. And as the Queen in England says, we will meet again. But thank you very much indeed.
Okay. Well, thanks so much for having me. I really enjoyed the questions, and good day to everyone.
Thanks a lot, Jim. All the best to you in St. Louis. Goodbye.
All right. Goodbye.